Okay, can you hear me now?
I can. Since this is recorded, let's move straight to the subject at hand. And I will start by paraphrasing the first President Bush by observing that at the time we wrote or edited this book, and for the purposes of our viewers, that's who we are, Dr. John Merrifield and Dr. Barry Paulson. At the time that we edited this book in 2019, we were already in deep doo-doo. Now, that's the quote from the first President Bush. And now in 2024, we are in much deeper doo-doo. Barry, could you elaborate on that for our YouTube viewers?
Absolutely. Well, we're experiencing what we call a fiscal cliff, and that's just another word for a debt crisis. And this is a relatively recent phenomenon for the U.S., but a debt crisis occurs when people lose confidence in your ability to pay your debts. And that's what's happening in this country. Of course, historically, countries have defaulted on their debts throughout history. Back in the 1930s, many countries defaulted on their debt. And more recently, in the 1990s, a number of Southern European countries and Eastern European countries defaulted. And Latin American countries have been defaulting on their debt for many years. The worst example, of course, is Argentina, which is a serial defaulter. Periodically, they simply can't pay their debts. People lose confidence in the ability of the government to pay debts. So they're closed off from debt, from credit markets, and their financial systems collapse. So, of course, this hasn't happened in the U.S., but we are increasingly exposed to this risk of default, and it's a quite recent phenomenon.
Yeah, at the edge of the fiscal cliff, what I see is, first of all, interest rates are going up because the buyers of the federal debt are starting to get a little nervous, to put it mildly, and so they're demanding a larger return. We pay way more interest here in the United States to finance our debt than other countries do, such as Germany. And so we're paying a premium, and not a good thing, to have them buy our bonds instead of buy safer bonds. And at the fiscal cliff, what's going on is that we're facing three things as this default risk increases: drastic cutting of federal spending, which is not entirely bad, pondering which taxes can be increased that will actually increase our revenue, and at what cost to the economy, and then last but hopefully least, the temptation to print money to avoid the first two. And if we print money big time like we did a couple years ago when we snuck up on the edge of the fiscal cliff because of COVID, and then of course the buildup of the debt up till that point. When we monetized a lot of the debt, that created inflation. And if we monetize the debt big time to avoid increasing taxes or drastic spending cuts, then we're looking at hyperinflation, and then we're going to totally lose our fiscal space to deal with emergencies, including possible defense emergencies. Because if we inflate and the dollar loses value, people are not going to lend to us when we desperately need to borrow, such as in a national emergency. So how do we get into this mess?
Well, I see it as a commitment problem. Basically, a government has to commit to stabilizing debt. And if they fail to do so, and by that I mean if they allow the debt to grow more rapidly than national income, you end up in the situation that we're in today. And as I said, this is a relatively recent phenomenon. And throughout most of our history, we didn't have a debt crisis. We didn't have this lack of confidence in the country's ability to repay debt. And the reason is politicians made a commitment to balance the budget. And I call this the old-time fiscal religion.
Indeed.
And throughout most of our history, it was simply accepted. Politicians accepted the fact that, okay, we can't incur deficits and accumulate debt indefinitely. We have to balance the budget in the near term. Now, what this meant historically is you might have emergencies, and especially military emergencies, where the government has to spend more than it takes in taxes and incurs deficits and accumulates debt. But after that emergency is gone, after the war is passed, then people accepted the fact that, well, what you have to do is generate surplus revenue and use that surplus revenue to repay the debt that you incurred during the crisis. Now, it's quite interesting because this continued right up into the post-Second World War period. And we still were committed, politicians were committed to balancing the budget and stabilizing the debt. And this is a bipartisan commitment. Dwight Eisenhower, Harry Truman, all of the presidents in that era agreed that you have to balance the debt in the near term. And Harry Truman, surprisingly, during the Korean War said, we're going to have to increase spending during this emergency, and we're going to have to cut other expenditures, and then we're going to have to run surpluses after the war to repay that debt. So that's what I call the old-time fiscal religion of balanced budgets. And we've abandoned it. For the last half century, politicians have abandoned this old-time fiscal religion of balanced budgets.
It's an incredible thing because, it makes sense from an economic perspective to balance the budget over the business cycle, run deficits during the slow periods, collect surpluses paid off during the up cycle part of that. But unfortunately, the person who put this out here, John Maynard Keynes, our fellow economist, he was a terrible political scientist. Because as you've noted, we do what Professor Keynes said in the recessions. We run the deficits, but then we fail to run the surpluses during the good times to offset that. So we have our debt's been growing for decades, but in the last couple of decades, it's been growing astronomically because we've run into some crises. COVID, the financial crisis 15 years ago. And now, as I said at the opening, we are in tremendously deep doo-doo because we're teetering on that fiscal cliff. Namely, we're paying interest rate premium, which is making things worse, of course, trying to finance the debt. The debt service at current interest rates, when all the debt rolls over to about 5% interest, which is what we're paying on short-term debt now, actually a little more than that, will consume a third of our revenue in our so-called federal budget, which is no such thing anymore. It hasn't been for 20 years. Our spending plan now includes debt service costs that will soon approach 1/3 of our revenue. So as George Will observed, we are sleepwalking towards a crisis. And I say that because as I talk to people, including my fellow economists, most of them have no idea that we're at this fiscal cliff and how bad this is, and that if we are to restore budgeting, there are drastic cuts and/or tax hikes in our future. And whether we want to balance the budget or not, it's going to be balanced eventually by the bondholders refusing to buy our debt at an acceptable cost. So what do you think? We need to limit spending growth. That's the main thing we need to do to restore the bondholders' confidence that we're serious about this so that the interest rates don't skyrocket. Any other thoughts on what we need to do to either not go over the fiscal cliff, which in my mind seems pretty unlikely, but if we go over it, at least manage the free fall into a smaller federal government, and or not cutting the wrong things to endanger our security? Any thoughts on what I might have missed in that little rant?
Well, you're absolutely right about Keynesian economics, that's for sure. And you're sort of a little bit younger than me, I think, but we were all in graduate studies back in the 50s and 60s trained as Keynesians, right? And we expected the government to balance the budget. And of course, that by the 1970s and 80s, it's clear that that wasn't happening, right? We abandoned the old-time fiscal religion. And during the Reagan years, I think that politicians, elected officials, recognized that this was a debt crisis. We were in the beginning phase of a debt crisis, and that we needed to do something about it. And so what they did in 1985, our elected officials, Graham Rudman, passed the Balanced Budget Act of 1985, which is a statutory law that says the federal government must balance the budget within the near term. And so this was a new thing. Before that, we didn't have any rules or any laws requiring a balanced budget. And indeed, in the 1990s, we did that. These rules, statutory rules, were pretty effective, and we balanced the budget in the 1990s. We stabilized debt, and we brought expenditures into balance with revenues. And it looked like we'd figured this all out by introducing these statutory rules. Well, as you mentioned, the last 2 decades, now we've abandoned that. We've abandoned these statutory rules. They've been amended a number of different times. But basically, what politicians do is to either suspend them or circumvent them so they continually incur deficits and accumulate debt, unprecedented debt. And during the 2008 financial crisis, the debt roughly doubled to 10 trillion. During the coronavirus, it doubled again to 20 trillion. Now we're up to 34 trillion, and it's projected to continue indefinitely until some projections are the debt will exceed twice our national income by mid-century. But long before we get there, we're going to fall off the fiscal cliff. People lose confidence in the ability of the U.S. government to pay its bills.
That's correct, and I want to end here because we're testing our viewers' attention span, and I want to alert all of our viewers, and thank you very much, to the fact that this is the first in a series. So please be in touch and visit policytalk.org for written versions of this, and please acquire this book. Even though it was done in 2020, every chapter is still as valid as the day we wrote or edited it. So have a look at that, and until next time.